Your paycheck just hit your checking account. The balance went up for a moment. It feels like every dollar that appears there must be income. But is that actually true? To answer that, start with the simplest idea. Income is money or value that comes to you because you worked, sold something, provided a service, used an asset, or received money from another legitimate source that you do not have to pay back. That sounds simple. But a lot of people get confused because they use the word income to describe any money that enters an account. That is not always correct. Imagine this. It is Friday. Your employer deposits $3,200 into your checking account. That is your paycheck. You worked for it. It is income. Later that day, a friend sends you $500 because you covered a group trip last month. That money is also coming into your account, but it is not new income. It is repayment for money you already spent. Then you move $1,000 from your savings account into your checking account. Your checking balance rises again, but you did not earn another $1,000. You only moved your own money from one place to another. That same evening, you borrow $2,000 to cover an emergency car repair. The money enters your account, your balance rises. But that $2,000 is not income either, because you must pay it back. Do you see the problem? Your bank account can show money coming in from several different directions. Only some of those dollars are income. This is why understanding income starts with one question. Where did the money come from? If it came from work, a business, a service, rent, royalties, or another legitimate source that does not require repayment, it may be income. If it came from a loan, a transfer between your own accounts, reimbursement, or money you are holding for someone else, it is not income in the same sense. The difference matters because the way you classify money affects every financial decision you make afterward. If you think borrowed money is income, you may believe you can afford more than you really can. If you treat a one-time payment like regular income, you may commit to monthly expenses that become hard to maintain. If you ignore side income, you may miss an important part of your financial picture. Let us make this more concrete. Suppose you work full-time and earn $4,000 per month before taxes and deductions. You also design logos on weekends and usually earn another $600. Your regular monthly income is about $4,600. Now suppose you sell an old couch for $300. That money is real, you can use it, but it is not a reliable monthly source. It is a one-time inflow. Then suppose you receive a $1,500 personal loan. That money is available to spend, but it creates an obligation. You must repay it. During that month, a total of $6,400 may enter your account. Here is the step-by-step breakdown. First, $4,000 came from your job. Second, $600 came from freelance work. Third, $300 came from selling an old couch. Fourth, $1,500 came from a loan. Add them together. 4,000 plus 600 equals 4,600. Add 300 and the total becomes 4,900. Add the loan and the account shows $6,400 coming in. But your regular income is not $6,400. Your regular income is about $4,600. The $300 couch sale is a one-time inflow. The $1,500 loan is money you must repay. That single distinction can completely change how you plan your month. If you budget as though you earn $6,400 every month, you may create spending commitments that your actual income cannot support. If you budget around $4,600 and treat the extra $300 separately, your plan is more realistic. If you also remember that the $1,500 loan must be repaid, you avoid mistaking debt for earnings. That is the first major lesson. Income is not just money that appears. Income is money connected to a source. Some income is regular. A paycheck that arrives every 2 weeks is regular. A monthly pension payment may be regular. Rent from a tenant may be regular if it is collected consistently. Some income is irregular. Freelance work may be strong one month and weak the next. A side hustle may depend on demand. Commission income may rise and fall. Dips may change from week to week. Neither type is automatically good or bad. The key is knowing which type you have. Regular income is easier to predict. Irregular income requires more caution. If your income changes every month, you should not build your spending plan around your best month. You should look at an average and prepare for lower months. For example, imagine your side hustle earns $1,200 in January, $400 in February, and $800 in March. Add the 3 months. 1,200 plus 400 equals 1,600. Add 800, and the total becomes 2,400. Now divide by 3 months. 2,400 divided by 3 equals 800. Your average monthly side income is $800. That average gives you a more useful planning number than the highest month alone. If you are already seeing the difference between money that arrives and income you can actually count on, subscribe. Your bank balance just became a little less mysterious. There is another useful way to think about income. Some income comes directly from your labor. You work an hour, you are paid for that hour. You complete a project, you receive payment. You deliver food, you earn money for the delivery. This is income from active work. Other income can come from an asset. You rent out a room, you receive rent, you license a photo, you receive a royalty payment, you own equipment and rent it to someone else. But be careful. An asset does not automatically create profit. It may have repair costs, taxes, insurance, vacancies, or other obligations. The income is real, but it may come with expenses. That is why income alone never tells the whole story. Two people can both earn $5,000 per month and have very different financial situations. One person may have stable salary, income, low debt, and predictable expenses. The other may have irregular freelance income, high medical costs, and family responsibilities. The number is the same, the reality is not. This is also why comparing your income to someone else's can be misleading. Income is affected by many things: your job, your hours, your skills, your health, your location, your experience, your family responsibility, the local cost of living, the availability of work. The goal is not to judge yourself by one number. The goal is to understand your own sources clearly. So what can you do today? Open a notes app or take out a sheet of paper. Write this title, money coming in this month. Then list every amount. For example, paycheck, $3,200, freelance work, $450, sold an old desk, $200, loan from family, $1,000, transfer from savings, $500, reimbursement from a friend, $120. Now place each item into one of three groups. Group 1, regular income. Group 2, irregular or one-time income. Group 3, money coming in that is not income. In this example, the paycheck is regular income. The freelance money may be irregular income. The desk sale is a one-time inflow. The family loan is not income. The transfer from savings is not income. The reimbursement is not new income. This simple exercise tells you more than your account balance alone. Why? Because your account balance only shows where money is sitting now. It does not explain where the money came from. It does not explain whether the money will come again. It does not explain whether you have to pay it back. Income is about the source. Planning is about understanding the source. Here is a common mistake. Someone has one strong month and assumes that amount will continue. They increase spending. They sign up for a larger car payment. They move into a more expensive apartment. And the next month is weaker. The problem is not always bad discipline. Sometimes the problem is using an unstable number as though it were stable. A safer approach is to separate dependable income from uncertain income. Use regular income for regular obligations. Treat irregular income more carefully. Do not treat borrowed money as earnings. Do not assume a one-time sale will repeat every month. Now let us return to the opening question. Your paycheck hit your checking account. The balance went up. But now you know that a higher balance does not automatically mean a higher income. You need to know the source. Remember three things. First, income is money or value you receive from work, business activity, services, assets, or another legitimate source that does not require repayment. Second, not every dollar entering your account is income. Loans, transfers, reimbursements, and money held for someone else are different. Third, income should be understood by amount, source, and consistency. If you can now separate earned money from money that is only passing through your account, subscribe, future, you may finally stop treating every deposit like a surprise bonus. At the beginning, every incoming dollar looked the same. Now you know better. A paycheck, a loan, a transfer, and a one-time sale may all increase your balance, but they do not mean the same thing. The next lesson is, what is an expense? Income tells you how money enters your life, but what causes it to leave? And why do some expenses feel invisible until the money is already gone? That is the next piece of your personal finance picture.